Okay, good afternoon, everybody. I'm sure you're all, I hope everybody's connected already. My name is Langenhoven. I'm with America Mortgages. A quick background on myself. I'm South African. I lived in England for about 10 years. Then I moved to Texas. I lived there for about 20 years where I got into commercial real estate. I owned my own commercial real estate brokerage company. And I was also an investor, bought and sold multiple commercial properties. I still have a boat and RV storage facility in Texas. And now I'm with America Mortgages helping people get loans for commercial property. So I kind of come to this from both sides. So let's get going with this presentation. So let's see. Investing and financing in US commercial real estate while living overseas. And I say welcome to a lot less hassle on here because compared to buying Airbnbs and dealing with tenants coming in and coming out and all the checking in and bookings and so on, this is typically a lot less hassle doing commercial real estate investing. So I'm going to kind of run through some of that. First of all, let's go through some of the terminology used in commercial real estate. The first one, obviously very easy. CRE stands for commercial real estate. That's a very simple one. NNN is something you'll see often in the marketing of commercial real estate. Now that stands for triple net. The three N's are property taxes. That's the most important. And then you've got building insurance. That's the second net. And then you've got maintenance and any other owner-related expense that could be involved with a commercial property. So those are the three N's. NOI is your net operating income. Now, the way you calculate NOI is you typically have the total income from the property, less your property tax, your building insurance, and your property maintenance costs and all other costs related to property management. And that is your net operating income or your NOI. Go back to the presentation here. A second. Why is this? Okay. Cap rate. This is something you'll hear a lot in commercial real estate because you've got to basically figure out what's the yield on the property. So if you look at cap rate, the formula is your NOI divided by your purchase price. So once you've calculated your NOI, you divide that into the purchase price, and that's your cap rate, your capitalization rate. Essentially, it's the yield on the property. So as an investor, you want to figure out what kind of a return you're going to get. So the cap rate is your like a quick rule of thumb to calculate what the kind of return is going to be on that property. The other important thing that you're going to come across in commercial real estate is IRR, your internal rate of return. Now, people often get confused by which one to use, your cap rate or your IRR. Now, the cap rate, if you think of that as a kind of a snapshot of a return on a particular day, and that day is typically the day you buy the property. The cap rate is only valid on the day it's calculated because it cannot see beyond the day itself. So on the day you buy the property, you figure out a cap rate, maybe it's 10% or something like that. Now that cannot see the future. Now it doesn't know that maybe tomorrow you're going to do some repairs or, a week later, there's going to be a rainstorm, you're going to get some damage and you get some loss on the property. Now, the internal rate of return, that's the one that can basically see the future. So let me kind of give you an example here. You can see here on this spreadsheet that we've got quite a complicated little analysis here. But essentially, this project was a project to buy 5 acres of land with a house in the back corner. This is actually a deal that I was working on myself. Lease out the house for 2 years, construct boat and RV storage in year 3, in year 4, continue leasing up, in year 5, sell. Now, this is where the IRR becomes really, really handy, because you can see in this column over here, you've got a purchase and sale, so that's negative in year 0, and then it's got a little bit of income, 26,400 in that year, and then the total is, negative 398,600. Year 1, which basically year 0 is the beginning of the year. Year 1 is basically by the end of the year, you've got some more income. Year 2, some income. Year 3, you see a big negative. Now, that was the year we were going to construct the boat and RV storage building. So there's a huge negative here. And then overall, at the end of year, that's a negative, but then you continue leasing up. And at the end of year 5, you eventually sell the property. Now you can see on this cash only internal rate of return, the return is 28%. Now, IRR means the return that you receive on each dollar you invested averaged out over the holding period. So in this case, a complete cash purchase would have returned 28%. But if we finance the property and put leverage on it, the deposit, the expense to you, your cash outlay is only 85,000, which is 20% of the 425,000 initial. So it's a lot less, obviously, to put down. And at the end, you're obviously returning less money because you've got to pay off the debt. But look at the IRR. The IRR is now 86% on this deal instead of the 28% because you've used leverage. So as you can see, the IRR compared to cap rate is actually pretty useful because you could potentially buy a property with maybe a 0% cap rate on day one because you might have a vacant piece of land that you've purchased. But in year one, you construct buildings and you construct a whole bunch of stuff, and that pushes up your IRR. So IRR is actually, to me, it's the more interesting one to use. Now let's look at the next item, the next piece of terminology that you're going to come across in commercial real estate. That's capital stack. Now, the capital stack is typically something that you'll only really come across if you do like a bigger deal. Let me show you kind of an example of a capital stack here. See if I can get this thing to the capital stack. Okay. So you've got 4 components of the capital stack. You've got common equity, which is typically you with your cash down payment. You've got preferred equity, you've got mezzanine debt, and you've got a senior loan. Now, all 4 of those components could be used to purchase a property. Now, in this case, let's just say we've got a $30 million deal. So a bank, and let's just say it's a multifamily property, worth $30 million, but you've got to remodel that property before you can lease it out. So if you're going to remodel a big deal like that, the banks which have the lowest interest rate, typically, they will not be prepared to do a huge majority of the deal. They might be interested in only doing a 50% of the deal. So that's this bottom one, the senior loan. Now that's obviously not going to be enough for you. So, and you can see on this deal, the senior loan is only 6.5%, but they're covering 50% of the loan. Now, if you can put on mezzanine debt, that's essentially maybe a different lender comes in and they will be prepared to do maybe 20% of the deal. So now you've got, out of the 30 million, you've got 50% covered by the senior loan at a low interest rate. The mezzanine debt, because it's in a riskier position, they'll charge you a higher interest rate than the senior loan. And beyond that, you can still have preferred equity. Now, this is potentially the same lender that offers you the mezzanine debt might be willing to take some preferred equity in the deal. So essentially, they're almost like partners with you, but they'll take a fixed rate of even higher than the mezzanine debt. So as you go sort of along this line, the cost of the money becomes more. And the last one, there's no interest rate because that's your cash, your personal cash you're putting in the deal. So essentially, to get all the financing for the deal, you put all these components together. Now you get a weighted average rate of interest on that financing. So you can see here, even though you've got some of the components are at a very high rate of, let's just say 12%, your weighted average rate is only 7.65%. Now, some interesting additional items about the way this capital stack works is that the priority of the debt is for the senior loan, which has the lowest interest, the priority is the highest. In other words, these guys can foreclose on you. And if they do, all these, the mezzanine debt, the preferred equity, and common equity do not necessarily get repaid. They fall lower down in sort of the priority. So typically, oftentimes, if a bank takes a senior loan or if another lender takes the mezzanine debt, they might want to have the option or the right to take over payments to the senior lender in case you stop paying the loan, because they don't want to get squeezed out. So they'll have a clause in the contract that they can take over payments to the senior lender to make sure that they don't get kicked out. The risk is in a different order. So the priority of debt payment was from the senior lender to the common equity, but the risk is the common equity has the highest risk in this position because they have the least rights. So the senior loan obviously is the lowest risk, but the profit potential for the common equity is the highest. So because they're in the riskiest position, they get the highest potential profit returns. So it's kind of interesting looking at the way that capital stack is put together, and it's a great way to essentially get into a really big deal. But obviously, that this is not something you use in like a $3 million or $4 million deal. This is for a really big deal. Other types of financing. Let's look at the bridge loan. Now, this is if you purchasing something that needs to be fixed up typically, because the conventional lender, the banks which have the lowest interest rates, they typically do not want to take the risk to put financing on a deal where they don't really know if it's going to be working that well, if it's guaranteed, and if the occupancy is still only 50%, 60%. So these guys, you have to go to these lenders that will provide bridge loans, and that'll basically get you from purchasing the property, fixing it up, and getting it stabilized. Once it's stabilized, you refinance these bridge loans, which are usually 12 to 24 months. Now you buy the property and you've got 12 to 24 months to fix it up, increase the occupancy, and get the rates up. And at that point, you can refinance into something which we call a term loan. So the bridge loan will be a short-term loan. It'll have higher interest rates. They potentially could make interest-only payments available to you. So even though the rates for a fully amortizing loan, the payments would be high, if you do interest only, it brings those payments down, which is typically what you want to do while you're fixing the property up and it's maybe not fully leased. You're not going to get high loan to values on a deal like this. It's going to be lower. And when do you want to use this? You want to use this when conventional lenders are not an option. You typically also can get faster closing times. So that really is if you're in a competitive position with other buyers wanting to buy a property, a bridge loan can sometimes really help you out to get into that deal pretty quick. So let's look at the term loans. A term loan, here you can get a much longer term. So obviously, you're out of that bridge loan situation. Your 2 years is done, and now you can lock in a deal for 20 years. In the US, if you're buying residential properties, you can usually get a 30-year amortization. Most of the time in commercial, it's 20 years. So that pushes up your payment. You want to put down a more of a deposit to make sure that payment goes down. In some cases, you can get 25 or 30-year amortization, and that's usually on multifamily, not on the other commercial types. Of course, you got lower interest rates, and you can get typically a higher loan to value, which helps. So you don't have to put down as much cash. So why would you want to use a term loan? Well, obviously, it's the cheapest financing option available. Usually, the rates, you can get fixed rates for up to 5 years. Some lenders will do 10 years. On some of the multifamily deals, if they're, depending on the lender, there are some long-term options to lock in rates for even 20 to 30 years. So that's very unusual. And it's usually only for the multifamily. So it's very suited. A term loan is usually what you want to get into eventually, unless you obviously pay off the property. Then we've got another type of loan is you've got non-recourse loan and you've got your debt service coverage loans. A non-recourse loans is basically the lender's recourse is limited to the property only. So they can't come to you personally to, pay up on the loan in case the tenants default and they don't pay and you can't pay. They basically just take the property and there's nothing else they can do. Now, in a situation like that, they are not going to offer you high loan to values typically, 50% and sometimes even less. In fact, there's a lender that I'm working with in New York. they will not do more than 30% LTVs, which is very, very low. So they obviously do not like to take big risks. Oftentimes, they'd want to see post-closing liquidity of 10 to 15% of the loan in a bank account. So in other words, they want to make sure there's a lot of money to service that loan in case the tenants don't pay. They want you to have the cash to be able to pay that note. They want to maybe see additional net worth of twice the loan. And sometimes they even want to see that net worth in the US in some, maybe you could have stocks in the US, or you could have just another bank account with the money sitting there, or you could have some kind of other investment in the States. So they ask for various things to kind of secure their future, essentially. Now, these are easier for deals that are bigger, and your debt service coverage ratio is going to be typically less. I don't know, we've got higher in here. So you've got basically, instead of maybe, it's going to be higher. Instead of maybe a 1.1 debt service coverage ratio, they're going to see 1.25 or 1.35. So essentially, the earnings of the property have to be that much higher than what your payment is going to need to be to the bank. Additional items that they're going to look at: what type of tenant do you have? If you've got a mom and pop tenant, they're going to be less keen. If you've got a regional tenant, basically, let's just say you're in Texas, you're buying a property in Texas, and it's a tenant that's got 5 or 6 locations, that's a little bit bigger than a mom and pop tenant, and they're going to be slightly more interested in that. But if you've got a national tenant or an international tenant, somebody like, let's just say Starbucks, that's international, that's something they would be more keen to finance on a non-recourse basis. They're also going to look at the type of market that you're in. If you're in a small town, less interested in providing finance for you. And then obviously they're going to look at the type of property you have. Is it in good condition? Is it, does it have a lot of visibility? Is it, that? So all of these things come into play when you're trying to get this type of loan. So let's look at the loan qualification criteria that the banks typically look at. I don't know if you've heard of the 5 C's of underwriting, but they typically look at character, capacity, capital, collateral, and conditions. Now, often I get people looking for financing, and they send me the link to the property. They tell me that they've got enough money to close the deal, and they want to know if they can get a loan. In fact, I had a deal like this just recently, and I explained to this gentleman, the banks look at a few more things. They actually, probably the most important thing that they look at is character. So I do need to get to the background of the individual that we're working with, and the banks really want to know, what have you done before? What makes you think you can do this deal? Have you, what's your experience to be able to do this? And your capacity is obviously your ability to do the deal. The deal I was looking at just recently, where this really came into play, this gentleman wanted to purchase a business that was in the agriculture business, but he had never had any experience prior to that in agriculture. And his people that he was working with, none of them had experience in that. In fact, the thing actually, what happened was, it looked basically like he was trying to pitch a deal to get money out of people, and I don't think he was that serious about actually doing a proper deal. But so we actually had to terminate, the working with him. So right there, we canceled the working relationship with this gentleman simply because of the first 2 items on this 5 C's of underwriting. He was not able to comply with those. Once the banks have looked at the first 2, they look at what kind of capital you have. And so that comes into play: what real estate you have, what equity in real estate you have, what cash in the bank, what stocks you have. All of these come into play. And the collateral is what can they tie to the deal. So the property itself obviously is the main one, but they sometimes could have other requirements. Now that's where the conditions come in. So once they've passed through the first 4, they look at the conditions and the terms of it. It's essentially the terms of the deal. So conditions could be something like, they might want to have the operating bank account with them. They might want to actually take from the net operating income, they might want to take the payment out themselves to make sure that that loan is going to get paid. That kind of condition typically comes into play when they've got no recourse. So they want to really lock that property and all the tenants and all the rental income really tight to themselves so that they do not lose any payments. So this brings me on to navigating the lender landscape. Yeah, as I mentioned, operating accounts, often they'd want to see that with themselves, with their bank. They might want to see additional deposits that so you could have some savings with them. If you have other loans with that bank or you have certificates of deposit, all of these items could help you qualify more easily with a bank for a new loan. And in fact, if you have existing loans with a bank, it's much easier to get another loan with them. You could have company credit cards that are issued by that bank that could help you. Essentially, basically, you want to expand your relationship with that bank, and the better they know you, the more products they have for you, the more easily they'll want to extend you additional credit. Tax returns is another item they typically want to see on if you're purchasing the real estate with a company. They want to see the tax returns of the company, and they also want to see your tax returns. And they don't want to see just the front page with your actual income or the company's income. They want to see the whole tax return, the whole thing. So with American mortgages, what kind of deals do we do? We like to focus on no less than 2 million. Now we've in some cases we do $1 million loans, and we're kind of seeing how that works. But from 2 million up to 250 million is what we can work with. And anywhere in the US, the banks really like to be in markets where the populations are 100,000 or more. We can obviously try to get you a loan on towns that are smaller. It's a little bit more tricky. If the population's like 30,000, 40,000, 50,000, typically the national lenders will not necessarily be that excited about something like that. But what I then do is I then find local banks in the area, smaller regional banks that maybe know the area very well. It's going to be a lot easier if we're in a big location like, let's just say, Dallas or Austin, or pretty much most locations in California, New York, the big cities, Miami. Those are much easier. The lenders know them very well, and there's just enough population to pretty much support any type of commercial property. We're looking at multifamily, mobile home parks, student accommodation, assisted living, all these different categories. I mean, there are so many categories in commercial real estate. It's actually tricky to even, there's not enough space to list them all. So I think the best is for us is send us a link of what you're looking at, what you're interested in. Let's have a call and we can discuss, the features of the deal. Because I was a commercial real estate broker for 10 plus years, well aware of all the different categories and how they operate. And, I can even give you some feedback on some of the deals that you're looking at. So another thing I recommend is to look at some news sources. While you're looking at deals, also look at the market. And there's some really good sources here. biznow.com, Globest, Connect CRE. The first three are free, and they really cover a lot of the news of commercial real estate in the States. Biz Journals, The Real Deal, and Commercial Observer are paid opportunities. And just quickly see if I've got BizNow. I've got BizNow over here. What I like about BizNow is they cover a number of cities around the States. So you can actually pick your city that you're maybe close, you're investing in that area. So I lived in Houston for about 20 years, or just outside Houston. So I like to look at the Houston market. And on BizNow, I can actually go to that market, and they basically cover all the news there. I'll come back to that in a second. You've got Globest, Commercial Observer. So I would suggest finding one of these that you like the flavor of the news that they send out, and keep track of your market that you're interested in. Because in fact, you'll get a lot of info from these. these news sites. Let's see. Now, where to find deals? Crexi is actually my favorite platform on which to find deals. They were not the first. LoopNet is actually probably the biggest right now. LoopNet and Crexi are very similar. And social media groups, you can look at Facebook groups, self-storage, multifamily groups. Let me see if I think I prepared one or two here for you guys. So here's on Facebook, a self-storage. Hang on a second, where is that? I missed that self-storage one. And here you've got multifamily investor groups. So you can see here multifamily real estate investors, multifamily strategies, multifamily real estate investing, a whole host of multifamily groups. That's a really popular category to be investing in. So Facebook's a good place where you can actually often find deals that potentially might not even be listed on Crexi. And you can see here this multifamily real estate investor, they've got 47,000 members. So that's really, interesting. Because I own boat and RV storage, I'm actually a member of the self-storage groups, and I get a lot of information on that. And it's actually so helpful also because if you're an investor, you could ask questions like, how do I do this? What I've come across this, and I need some help. So those, I would really encourage you to look at the Facebook groups. So let's look at some example deals that I've come across. And these are all from Crexi. This is an extended stay motel. They're asking 3.5 million, 21,000 square foot, 55 keys, basically 55 bedrooms, and a 12.5% cap rate. So now basically this means that after all expenses, you should earn 12.5% on your investment. So that's 12.5% on the $3.5 million asking price. But you might only have put down 20%. So $700,000 is what you invested, but you're getting 12.5% on that. So you're essentially earning money over and above what your interest rate is that you're paying the banks, hopefully. But so unless you've got what called a hard money loan, which is at 12%, that's not going to cash flow. But if you have a rate of, let's just say 7.5% or 6.5% on the property, you're clearing quite a bit on this. And this one's consistently leased, they say, at 90%. So that looks like an interesting deal. And it was only listed like 3 weeks ago. So it's a very new deal. This one is a triple net deal. Now, triple net deals, you typically find this when there's a single tenant. When you've got multiple tenants, they don't normally talk about triple net. But when you have a single tenant like this is, Greyhound Bus Terminal, you get what's called a triple net. And they usually have a long term. Now, this one's got 4.6 years remaining. Now, most likely, this lease agreement originally was 10 years. So this one is halfway done. But they're going to basically take care of they're going to pay the rent to you. They're going to pay the property tax, and they're going to pay the building insurance, and they're going to pay for all the maintenance. Now, in a situation like this is why I say commercial real estate can be a lot less hassle. Because in this instance, if you signed up the deal at the beginning for 10 years, you would not have to literally worry about a thing. I mean, there's absolutely nothing for you to do. You don't even need a management team to deal with this because there's nothing to do. They literally do everything. You don't even have to. In some cases, there might be a clause for you to fix the roof if the roof caves in or something like that. But usually the day-to-day maintenance and the cleaning of the property and the small issues like replacing light bulbs or, if the toilets are clogged, they'll clean that. That's got nothing to do with you. That's the tenant all by themselves. So triple net deals for somebody that likes low risk and low hassle, a triple net deal is kind of what you want to look for. The other way they call them as well, you'll sometimes see STNL, which basically means a single tenant net lease. And in this instance, it's an 8.11% cap rate. So that's the return on the purchase price, not on the money you've invested. That's what's called your cash on cash return. Now that's a different number, and it's usually going to be much higher than this. And this one has annually a rental increase of 3.5%. So now that could be written into the contract. So those are interesting deals to look at. This deal, a self-storage deal in Venice, Florida, has an 8% cap rate. Oh, it's got 8 and 11. I think it's basically the same, but essentially 461 units, so 461 potential tenants, which is obviously a risk reduction for you because you could have, 5, 6, 7 tenants leave, and it doesn't matter. You've still got, 400 plus other tenants, and you can, of course, replace those few that leave. So self-storage is super popular. There are tons of Facebook groups that deal with self-storage because it's a really big business in the US. In fact, it's expanding to Europe now, I see as well, but there's just tons of self-storage opportunities in the States, and lots of people are trading in and trading out. So you will always find opportunities to buy self-storage. Let's see. So some contract signing tips. So here, I think often it's probably a good idea that we chat before you sign a contract because the financing could affect your feasibility period. And typically in the States, when we put a contract on a property, it's not like buying a house. We do not have a short 1 week feasibility to do a quick inspection and see if there's any major damage. We want a feasibility period of at minimum 30 days, but sometimes it could even be 45 days to 60 days. And the reason is because it's a little bit more complicated. The lenders are more tricky to work with. You might have to do environmental studies. You might have to do, other, if it needs any construction or any remodeling, you have to get quotes for repairs. You might have to work with engineers. You might have to work with architects. So having a long feasibility period or long enough is super important, because what you don't want to do is you want to lock yourself into a deal where suddenly you're in a crisis situation and everybody's panicking because they just got no time to do anything. So if you're new to commercial real estate in the States, let's talk about how to put that contract together so you give yourself enough time for the feasibility. Now, typically that feasibility, you're going to have to put down what's called earnest money. So you're going to have to put down, usually it's a 1% deposit, or 1% of the purchase price deposit. It's held in escrow with the title company. And in most states, I think it's in pretty much all states, if there's for any reason that you do not want to move forward with the deal, your earnest money is returned in full. So it's a low risk situation during the feasibility period. Once your feasibility period is over, that earnest money is now forfeited, essentially. It's at risk if you don't close the deal. So you have to be sure that you want to close the deal before you finish that feasibility period. And then you've got the time to close the deal. So that gives the bank just enough time to get their documents together and to essentially prepare for closing. On the contract, you can obviously, there's usually an opportunity for special or other conditions. And you might want to say there something about maybe you want to create an LLC to purchase the property with. In some cases, you've seen the property and you like it. And because it's a competitive situation, you don't want to waste any time. So you put a contract on the property, but you don't have the LLC yet. So what you could say in the special conditions, you could say that seller agrees that buyer has the right to transfer this contract to an LLC prior to closing, which then allows you to create an LLC after you've written the contract. And then you essentially just transfer the contract that you've got to the LLC once you have the LLC. So you don't always have to have the LLC in place before you put a contract on a property. Now, I've heard that currently it's taking a very long time to issue EIN numbers, which is essentially the tax number for the LLC. So, I've heard that it could take, anywhere from up to 60 days even. So currently, that's a bit of a problem. I don't quite know how to get around that, except you just have to wait. And I'm not sure if this has got anything to do with the layoffs that the Doge team are, executing in the States, that it's affecting the IRS from issuing EIN numbers. But these are all conditions and items that you might want to think about before you sign that contract. So the more people you can talk to, maybe your attorney, myself, or people in the market, your broker, to get advice on what's the length of time these things take, and then make sure you cover that. So again, here's my contact information. We're going to go to some questions and see what we've got. Let me see. Somebody is asking, should I first get pre-approved for a loan, or should I first get the property under contract? It's tricky in commercial real estate to get pre-approved for a loan, because we don't really know yet what you want to buy. There's so many different categories of property that it's probably best if you send us a link to the property that you're interested in making an offer on. And once I have that, I can put together a deal package for a bank, because essentially what we're going to be partners in this deal. I'm here to help you get the financing you want, because we're not a direct lender. I mean, we're not approving the loan ourselves. We're working to get you the financing that you want. So I have to reach out to banks and various entities that do commercial loans to foreign nationals. So I'm going to put that deal package together for you. And we might not get a pre-approval exactly, but it'll essentially give you like a sort of a guideline of what you can do with a particular bank for that particular property. Let me see. Instead of providing tax returns, could I just send a letter from my CPA stating my income? It might work with some banks, but usually the banks want to see a tax return. So yeah, we could try. I'm always happy to give it a try. And it could be something that could work with the bank, but a tax return is usually the best. And what I see everybody's asking for, they're asking for at least 3 years of tax returns. So that's something. So let's see the next question. If I find a commercial property that I like, should I deal with the listing agent directly? Well, in the States, it's typically people have they have their own agent, their buyer's agent, and the listing agent works essentially just with the seller. It's very difficult for an agent to be on both sides of the fence. So, in my opinion, I'd want to have somebody that's going to advise me my best, strategies and my, the best way for me to get a deal and the best way of negotiating. And for that, I need my own agent. So my suggestion would be, if you find something, let's just say on Crexy or LoopNet or Facebook or whatever, is find a commercial broker in the area that you want to invest in and let him, represent you. It's not going to cost you any more. The seller typically pays the agent, and you're going to get much better representation, because ethically, if it's one agent dealing for both the buyer and the seller, if the guy's ethical, he's not allowed to actually give either party, special advice or anything that, inside information. He's supposed to act impartially, which means you might not get all the information that you could need on a deal. So I think it's best to establish a relationship with an agent in the area that you want to invest in, and then let them help you out on the deals. How long does the loan approval process typically take for non-residents? Well, if we have all the information we need and we have the property, and the deal is a solid deal in a big town, and it's cash flowing, the better the deal and the more documentation and everything stacks up, it could just take a few weeks essentially to get the sort of initial approval. Now, obviously, closing the deal could take longer because there's more stuff to do. Like they want to potentially do an appraisal of the property. They might want to do, get some other information, but just closing loans can take 30 days. I think the closing is, let's just say 30 days, and the approval could take it. I mean, if we literally have everything we need, it could take a week to get a pre-approval. So it's really just a case of, has the contract already been drawn up? Do we have a contract already? And do we have all the paperwork we need from you? Then it's much quicker. So, but if we're starting from I don't have the property yet. It's difficult for them to pre-approve a loan when we don't even know what we're buying yet. So it kind of depends on that. Okay, now I've got a question here from Ambrose. Do we
And
need down
answer.
payment?
Before we
Yeah?
get into the next question, you can stop your screen share now.
Okay, right. Sorry. Okay, here we go. Ambrose, yeah, do we need a down payment for all commercial real estate loans? Yes. I don't know. There's no one providing 100% financing. Now, what you could do, if you don't have the down payment yourself for all of the deal, you could get, talk to friends and family and essentially, get somebody else to put down the down payment, and maybe you manage the deal. But think about this. If you don't have any money in the deal yourself, you're going to just be working for other people. So I would suggest maybe just saving a bit more, and do smaller deals. If you do a few residential deals and buy, fix up and flip, you can snowball your investment amount, and then you can qualify for a commercial deal. And here I've got another question here. Is there a limit to how many US commercial properties I can finance as a foreign investor? No limit. You can buy as many as you can afford. So that's a nice thing there. Let me see. What's the next one? Ambrose again. Is Zillow not a good source for sourcing real estate deals? Zillow is good for residential real estate, not for commercial real estate. So that's not, they don't do commercial. Let's see. What kind of documentation do I need if I'm self-employed or own a business overseas? Well, tax returns and a list of your assets. I mean, that would be a good start. And of course, information on the business that you own. So yeah, we could put that together as evidence of what you're doing, and provide some collateral. Next question. I'm a non-U.S. passport holder for a commercial loan. What is the minimum down payment, and what would be my average rate expectation? For foreign nationals, the down payment is typically higher than if you were an actual U.S. resident. So it's usually, let's just say, obviously the deals are very different across the commercial spectrum, but start off with thinking about at least 30 to 35% deposit down. Now, it could be less if it's a multifamily deal. It could be potentially, depending on the loan program, it could be maybe 20% down payment. But I would bargain on 30% at the very minimum cash down payment on a commercial deal. And the rate, again, this depends on the kind of deal. It's, they're all different. But I would think at the moment, if you got a 7.5% or maybe 7% interest rate, that's a very good rate in the current environment, 7 to 7.5%, if as a foreign national. And then it just goes up from there. And let's see, what's the length of time it takes? Next question. What's the length of time it takes to get approved, and how long does it take from application to closing a transaction? Yeah, approval, if we have a contract in place and we have all the documentation that the banks are asking for, it could be maybe a week or two to get pre-approval. And then closing the deal, typically want at least 30 days. The banks need time to get them. Nothing less than 30 days. Now, if it's quicker than that, great, but it's usually going to be 30 days or more. I own a commercial property in Hawaii. The next question here. I own a commercial property in Hawaii. It's worth 15 million. I don't have debt. How much equity can I release? On a refinance of an existing property, I think we could probably get 65 to 70% of that released. So I'm assuming that property is fully leased, but I think probably, why don't we do this? After the call, you can set up a Calendly appointment with myself, or my phone number is also on the screen. You can call me or set up a call, and we can chat about it, and I can maybe give you some better information on that. Next question. Do commercial loans qualify on property cash flow or personal income? Most of the qualification is on the cash flow from the property. So the better the cash flow, the better or more easily it is to qualify on that loan. So in fact, usually we don't actually want to take the personal income into account at all if we can help it. So that's one of the good things about commercial real estate. Next question. I see in the chat you have a calendar link. Is that how we can schedule a meeting with you? Yes, there is a link, Calendly. It's on my calendar. So basically just schedule a call and I'd be happy to chat with you guys about deals. I personally know the Houston area extremely well. So Texas, I know Florida pretty well, but I can not only advise you guys on, the financing of a commercial visa, I might actually even be able to give you some feedback on the actual deal that you're looking at and give you some feedback on that, just because I was a broker for 10 years. And, I did many, many deals, so many categories: golf courses, mobile home parks, self-storage, land, retail, all sorts of office. Let me see what else. Next question. This was extremely informative. Thank you. One question. Can you assist me in finding a property if I can give you my parameters, such as cash available, etc.? I'd love to offer to find you properties, but I don't have enough time to do that as well, especially if I get that request from many people. So even though I'd love to help each one of you find the right deal, I just don't have the bandwidth. I think if you use the tools, if you use Crexy, you can set up a filter for what you're looking for. I'll tell you what, why don't you set up a call and let's discuss what you're looking for, and maybe I can help you out with some areas to look in and so on. And I can give you some tips on how to find the deal that you're interested in. I think that'll help you, just so you can kind of get started. And then once I've got you started, if you look around and you keep your eye on the market, and then when you find something, I'll be happy to give you a review on it and give you my feedback on the deal, so that you can kind of get some comfortability. You can start feeling comfortable about how to find the right deals. And once we've done 2 or 3 reviews, you'll know what to look for, and then you can go from there. And then obviously once you get the one that you want, get in touch again, and then we'll figure out how to get the financing on that deal. Next question. Do I need US credit to get a commercial loan? No, you do not. That's the beauty of this thing, because obviously all foreign nationals, and that's all we deal with. We just deal with foreign nationals. Nobody has US credits, so you do not. Okay, let's see. Next question from Sophia. Would you always recommend starting with a residential before commercial investing? I think it's a good place to start. You get your feet wet with some deals and you see how it works with real estate. I mean, that's how I started. That's how most people start. They start with a single family. They start with an Airbnb. They start with something small, and then they flip that. You don't have to. Yeah. In fact, I'll tell you the other reason why I like commercial real estate versus residential real estate is, in commercial real estate, you don't deal with what they call the 3 T's: tenants, toilets, and trash. So, tenants in a house, it can get extremely emotional, because these people are living in a home, and they obviously, if it gets cold, they need to be warm. And if they're too hot, they need to be cooler. And if it leaks, if the roof leaks, they get wet. And, they're always going to be extremely emotional about their living space. And that's nothing wrong with that. But because of that, it can get the discussions can get extremely heated. They can get very uncomfortable, and you always have a lot of stress that you're dealing with. Now, in my commercial boat and RV storage, where people just park their boats and their RVs, I mean, I've had a tree fall over onto one of the spaces, and it took us, I think, 2 weeks to repair it. But nobody was stressed. Nobody was frustrated. They realized this was just something that happened. We never have plumbing issues because there's no toilets anywhere. We just don't have any stress. If anything happens, well, I literally have nothing happen. I mean, there's almost hardly ever any issue. The other thing with a commercial property is you can inspect it pretty much any day of the year. Let's just say you've got a retail shopping center that you're leasing out. I mean, you can walk in any time of the day to kind of see what's the condition of the property. And whereas with a residential property, you just can't walk in on a tenant because it's their home and they're private, and you can't. But that prevents you from seeing what's going on. So you come back 3 months later and the place could be trashed. So that's why I personally like commercial real estate, because at 5 o'clock, everybody goes home. Nobody sleeps on the property. So that's kind of one of my rules for myself. Next question. What is the easiest type of commercial real estate to purchase with the best ROI? I'm agnostic about location. Oh boy, the easiest type of commercial real estate. The thing is, the easiest and with the least hassle is a triple net deal with a 15-year lease from Starbucks. And but because that's the easiest and it's the lowest risk, the return is not the best. I mean, you're going to be getting a return of 5% if you're lucky. If it's in California, it might even be less. So yeah, it's those two do not go hand in hand. Here's the rule of thumb. If you're reaching for more ROI, you're reaching for more risk at the same time. So you've got two hands. One is reaching for ROI and the other one at the same time is reaching for risk. So the more risky deals get the better ROI, but they usually come with a little bit more hassle. You might have to do a little bit more work. As for location, yeah, I mean, you could buy in any big city in the States, and I think you're going to be fine. The beauty about the States is it's such a well-developed market. The rules are so clear. It's so transparent. It's a wonderful place to invest. I mean, that's why I keep even though I'm currently living in Portugal, I'm keeping my boat and RV storage in Texas. In fact, I'm expanding it. Over the last 3 or 4 years, I've built 6 additional buildings on the property, and I have not even seen them in person. I've just done it all here from Portugal. And I have additional projects I'm going to be developing in the next few years. And so I'm happy to keep investing in the States. And so I love the market. It's such a huge market. There's so much demand. It's just wonderful. Let me see. Ambrose, another question here. With the way the new government is cracking down on visas, etc., what is the impact on foreign buyers who might want to visit the US before, during, or after investments? I really don't think they're going to stop people just visiting the States. I mean, I have heard about some hassles for people. I'm not quite sure exactly why, but if you have a travel visa, I don't see the problem in going there. In fact, I'm working with a number of Canadian investors at the moment, and in fact, right now the travel from the Canadians to the States is down, but people in the States are saying, "Come back, come back." So they want them to travel. So I haven't seen a problem with that at this point, Ambrose. I can't really tell you. Let me see. Anonymous attendee, I enjoyed your presentation. Thank you all. Thank you very much. Happy to help. Happy to chat to anyone who's interested. How can we reach you? There should be a Calendly link, and you could just schedule a call with me. Happy to chat. My number, if I'm on WhatsApp as well, my number is a US number. It's 832-483-8655. So if you want to take that down on WhatsApp, 832-483-8655, and just send me a text and we can set up a call. Let me see. Next question from Rod Beaton. Does a customer's tax return have to be for the most recent fiscal year? Is a single year sufficient for income verification, or does the customer need to provide multi-year? No, we typically need 3 years of tax return. So 1 year is not going to be enough. Banks want to see trend and they want to see consistency, and they cannot see a trend and they cannot see consistency from a single year. It's just not enough. So I've run through all the questions. So let's see. Does anyone have anything else? Robert, did you have anything that you wanted to add?
No, I'm good. Thanks everybody for joining, and thanks Lance for your time, of course. Super informative, very interesting, and I think everybody gained, I know I did, a lot more knowledge than I had on commercial real estate for sure.
Oh, good. If I managed to teach you something, Robert, that's something.
So you can close it off if you'd like, and maybe say your final statements or last words, or however you want to put it. And thank you everybody for joining as always. And we look forward to seeing you at the next webinar. Lance, you want to close it out?
Yes, thanks again. I enjoyed giving this presentation and looking forward to speaking to some of you on commercial real estate and the financing that we provide. And we'll see you on the next one. Thanks, Robert. Thanks, everybody.